off to the guest speaker.
Thanks so much, Saurabh. I really appreciate you walking us through the investment thesis. As Saurabh mentioned, we do have a guest speaker today. I have Tom Flannery with us. Tom Flannery is part of our East Coast Advisory Board, as well as the president of Flannery Consulting, and he's going to be giving us a little discussion today. So I'm going to go ahead and let Tom introduce himself. Let me make sure you're unmuted.
A quick presentation. All right, first introduction. I'm Tom Flannery. I spent about 30 years on Wall Street. I worked at a couple of shops that don't exist anymore, Bankers Trust and DLJ, and a couple of ones that you probably are familiar with, Merrill Lynch and Credit Suisse. I worked in non-dollar equities, so any stock that traded outside of the US region was something that ran through my desk. I was not sales or analyst, I was trading and sales trading. So we managed risk in each of those countries. And any client in the US, Canada, or Latin America that was going to trade would run through my desk. So I did that for about 30 years and then retired about 5 years ago. So today I'm going to talk to you about technical analysis, which is very different from what you're learning at YIS. The core of what we're doing at YIS is fundamental kind of stock picking, do the hard work that we just talked about, have an investment thesis, pick a company, pick one that's cheap, and then have some conviction. One of the tools that you can use to dovetail with that is technical analysis. Now, hold on a second. I'm going to try and share. Technical analysis, the principles and assumptions that go along with what it is. It uses price and volume market data and then graphically displays it, which I'm sure you've all seen the graph of a share price or an index going up and down with variations over the course of the day. Technical analysis can be used for any security as long as there's enough liquidity, enough volume trading to have some sort of standardized pattern that goes along with it. And in a nutshell, it's a study of trends and patterns. So you'll see on the left-hand side there, what are the concerns of the technical analysis? It's price changes over a period of time, and you're considering volume as a variable input of the first two. When you combine those, the prices create what we call support and resistance levels, and I'll give you some examples of those in a minute. Once you have that concern completed, it breaks into two main categories: pattern recognition and indicators. Pattern recognition is exactly what it sounds like. The graph looks like something, and it should look like that over and over and over again over time. And indicators are, you're either measuring price change or time or volume in different formulas, and then you're getting indicators that would hopefully point you whether or not the stock is going up or down. It only works if the analysis brings together the collective wisdom of multiple participants. So when you guys graduate and you all show up on Wall Street, there's thousands of analysts that are analyzing Apple or Tesla or pick a stock. Those analysts then put that collective wisdom together and deliver it to the buy side, to the rest of Wall Street, and a consensus is formed. If there's 100 analysts that are covering Apple and 95% of them have a buy, generally speaking, the stock will be well bid because they're telling all of their investors, you should be buying Apple. And what will happen on the back of that is the share price will generally appreciate over time. So the analysis relies on that collective wisdom to put the money into whatever instrument we're dealing with, in this case, Apple, and it will move the stock. A technical analyst then steps back and says, I'm not paying attention to the fundamentals right now. I'm going to allow that collective wisdom to work and move the market. And the beauty of that is, well, the 95 analysts all have a buy for a good reason, hopefully. The stock's cheap, it's got great prospects going forward. All of the things that say check, it's a buy, 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 as opposed to 27 checks that say sell, creates something called a psychology of investing biases. And the chart on the left, if you have time to read it, it's the, well, first question, are you guys actively investing? Have you put your own money in? Just a nod or a thumbs up or yes, generally. So you'll recognize when you buy a stock, there's an emotional attachment to it. It's your money. If the stock goes up, you feel great. And if you bought it yesterday and the stock collapses 15% today, you feel really bad. And the decision-making process that goes along with that emotion drives what people do when they're buying and selling stocks. So I'm going to dovetail this in perfectly with what you learned in today's lesson. It was high conviction stocks. Your investment thesis needs to cancel out white noise. If you firmly believe that you should be buying now and the stock trades lower and nothing's broken in your thesis, you shouldn't get emotional about it and say, oh my God, I've lost so much money, I need to sell it now. The last speaker, as he was wrapping up, said, having that conviction is really important. So the graph on the right gives you those feelings, and I won't run through them, but they range from optimism, I think it's going to go higher, so I'll buy it. And when it gets to the peak, and there's 100 analysts out of 100 are saying Apple's a buy, there's euphoria. Stock's going higher forever. And at some point, it gets too expensive. And as you guys as analysts know, you start putting sell orders in, sell recommendations. And as the share price declines, you get to a point where it's desperation and panic and capitulation, where you go, I can't lose any more money, I'm finally going to sell it. And then when there's no hope left, you're at the bottom. What the technical analysis tries to do is it removes that emotion, Gesundheit, Christine, it removes that emotion from the process. So how does it work? That I've just kind of run through why use both. You've got your fundamentals. The technical analysis should help you alert and confirm and predict whether or not your thesis is correct based on the collective wisdom. So how we do that, the graph that we talked about, there are a couple of different charts: line chart, bar chart, candlestick chart, point and figure chart. I'll run through some of the basics. Line chart like this, nothing sexy there. This is a bar chart. This is what you're generally going to use. On the right-hand side, that's high, open, high, low, close, is one of the bars in the broader graph. So each of the hash marks that you see on the screen, the hash mark to the left is where did the share price open today? The low is obviously the low of today, the high of today, and where did it close today? It's not just days. Time interval is hourly, minute, weekly, monthly. So the technical analysis works over any time period N. I'm going to blow through some of these. So volume. Volume determines supply and demand. If you have 10 buyers and 1 seller, share price is going up. And if you have 10 sellers and 1 buyer, share price is going down. Measuring the volume on the graph helps determine, are there more buyers? Are they more aggressive than the sellers are? And you can see in the volume bar charts that we're going to get to in a second are going to help determine some of that. So different types of indicators: price-based, volume-based, time-based. There's momentum. Is the direction of the stock up or down picking up with time? Is it moving higher faster, or is it moving lower faster? In a panic, things move lower very fast. People are price agnostic. They just say, sell. I'm in capitulation, and the momentum of that selling will drive share prices lower. Oscillators, relative strength, standard deviations, trend following patterns are all different types of technical analysis that we would use. So first and foremost, it's a trend. Law of physics. A body in motion tends to stay in motion. If a share price is moving up, it tends to continue to move up. And if it's moving down, it tends to continue lower. You don't see a lot of shares that don't have a lot of appreciation or depreciation over a period of time. So what's important here is to see higher highs and lower lows. And I'm not really too sure what button I just pushed. Hold on, let me get back to where we were. Here we go. So in order to determine trend in technical analysis, you need to have a series of higher highs and higher lows, or lower highs and lower lows. So we'll do the highers first. Share prices down here. This is the capitulation, despondency. Here comes the optimism. I think the share price is going up. It peaks. This is your high, and then it sells off a little bit over the course of a couple of days. The next wave higher, this high, can you see the mouse moving? Okay. This high is higher than this. This high, higher than the last, higher than the last, and the same sequence for the lows. Below that line, you connect these low points, and that's your trend line, and it gives you a directional basis for the stock. So if I have a series of higher highs and lower lows, and this is very simplistic, we'll get into a little more detail in a minute, I can start to plot a trend and say, well, if it breaks below this line, this point right here, on the next leg down, I no longer have a higher low. Something broke, something went wrong. The trend would no longer be intact. The same sequence on the downtrend. A high, a lower high, a low, and a lower low. And the trend connects the tops, the highs, and gives you the direction. So by reading those indications, as a fundamental analyst, you're going to put your analysis in here, and you're going to say, this stock is really cheap here. You've picked up most of the downtrend. You've done your work. It's trading cheap relative to its peers. It's trading cheap relative to its market. The investment thesis is good. This is a video game. We know that in 6 months, they're going to have a new launch. My kids told me this is going to be the greatest thing in the world. We should be buying the stock. Well, so this is where you make that decision. And you're going to now use your technical analysis to decide, is now the right moment to buy? So if I can use my analysis to say, well, let's see whether or not we break that trend. If I buy here, I have to wait all of this time until I get back in the money. So up until this level, you're not really in the money. So whatever this period of time is, it's dead money. You should be using that to do something else. You would look and say, all right, I still have a lower low and a lower high. Now is not the moment to do this. You could get head faked into it here and say, hold on, I now have higher highs. So you've got this period of time where you've added alpha. If there are other trends that tell you now is not the time here, whether it's volume or other reasons, you may choose to wait until you get a clear picture of a trend that's moving up, and that saves performance of the portfolio. Support and resistance, critically important with trends now. A sequence of price peaks and valleys. Every time a share price moves to this level, it'll have difficulty. Go back to the psychology that we talked about, the bias in investing. If you were the guy that didn't capitulate here, but you get a little bit of a rally and you go, man, I made a little bit of my money back, I'm selling it. Every time it gets back up to these levels, you'll find some extra selling that comes in. Once it breaks through that level here, a resistance line now becomes support. Every time it trades back down to that level, it'll find more buyers because it's had a little bit of a breakout. This is a perfect example of that. So you've got these trend lines coming in here. They're breaking, they move through. Whoa, sorry about that. You've broken the trend here. It broke down. This level now becomes resistance. All right. Relative strength. So when you guys do your analysis, you identify the companies being inexpensive relative to what? It's not in a universe by itself. It has to be inexpensive to something you could better use your funding for. You only have $100 to invest. You're going to buy one stock. You want to buy one that's cheaper than everything else. So you can use relative strength analysis to determine, well, is the stock that I'm looking at performing better than its peers or worse than its peers, or better than the index or worse than the index? I'll give you one example of pattern recognition. This is called a head and shoulders pattern. So we have the series of higher highs and lower lows, and the trend is up, and you have a big gap. This gap becomes a support level that we talked about. So the share price rallies up a little bit and then comes in a little bit, and it finds support at this level. If it does, it's a great buying opportunity. If your analysis tells you it's cheap here, the first thing you have to ask is it a potential head and shoulders? Can I buy it in 2 weeks or 3 weeks or 2 months and get it a little bit cheaper? When it comes to support at this neckline, you start buying more aggressively. You get the head, the fade back to the neckline, which is support, a bounce off that because the buyers will show up here, 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 again, over and over again because of the psychology, until it eventually breaks down. And once it breaks down, it becomes a resistance level. There are lots of patterns. There are either flags, pennants, W's, W tops. There's a fair bit to go through. So let's run through a couple more. The next big one that's really important is price patterns. So if I were to take the closing price of a security for the past 60 days, add it all up and divide by 60, I'm going to have a moving average. It'll be the average price of the last 60 days worth of activity. If I plot that line or plot that point in series with the time of the share price, what it ends up doing is smoothing the curve of the share price. And it gives you a clear indication of, well, what's the trend doing? And like the other support and resistance levels, if the share price is above the moving average here, it's trending higher. Once the share price crosses below a moving average, the trend changes until it crosses back above here. So this entire series, if you said the stock was cheap here in the middle, and it might be, but that doesn't mean it can't get cheaper. Using technical analysis to determine has the trend stopped going lower can help add alpha to your portfolio. The moving averages can also be different time periods. If you're a long-term investor and you have a 5-year time horizon, you can use monthly data, and you can use 10 months, 50 months, and 100 months. These curves then will be smoothed even more. And if you're a fast money trader and you're trading currencies, you can use 1 minute, 2 minute, and 10-minute graphs and moving averages. And they work the same regardless of what security you're using or the time frame. The patterns are always the same because the psychology of investment bias is always the same. So we talked about standard deviations before. If I take a share price and I measure 2 standard deviations above and below that price, it'll give me a mean in the middle. when something moves more than 2 standard deviations away from its average, it's an aggressive move. Generally, what we have after that is a reversion back to the mean. So a share price that trades at 2 standard deviations here where I'm circling, there's a pretty good assumption that at some point it will trade back to the mean level and then reverse another standard or 2 in the other direction. So you can use these bands that wrap around the price also as indicators. Here at the top of the band, probably a little more expensive. At the bottom of the band, a little less expensive. Rate of change oscillators. So we run some math on pricing, and it's the rate of change of the price over a period of time. You divide the whole thing multiply the whole thing by 100, and you're going to have this indicator swing from 0 to 100. The higher it goes, and if you line up these levels, when it peaks, they're aggressive buying. You'll probably get a reversion. And if you line it up with the share price here, this peaked at the same time as the share price. This peaked and started going lower. The share price peaked and traded lower. At bottoms here, you had a bottom in the share price. So as the oscillator swings lower, it will give you an indication that the share price is about to turn. Relative strength we talked about already. Stochastics is another oscillator. Same thing. If you look at every time, so this is based on 100. This line is 80. The bottom line is 20. Every time you get above 80, you generally get a little bit of a sell-off here, here, here. And every time you get to 20, you have a little bit of a rally here, here. So all of these indicators matched with your fundamental analysis help keep your investment thesis in focus. If you look and say, I paid for the share price at this point, and over the course of February, March, April, the course of the next 2 months, it does nothing but trade lower. But it doesn't break this trend line, keep your conviction. There's no reason to break down. This is confirming with you that your thesis is correct. Another oscillator, but this is moving averages on rate of change. And where the moving averages cross over coincides with highs and lows in the share prices. This crossover here where the fast line and the slower line cross coincides with this peak. So if you're putting your analysis together and you find it inexpensive here at this point where the oscillator is starting to look like it's going to roll over and go lower, double check your math, wait a little while longer, get confirmation from the technicals before you actually pull the trigger. Sentiment. There are other kinds of indicators that you can use. Opinion polls. Merrill Lynch or Bank of America does a really good one called a fund manager survey. They survey, 1,000 fund managers every month, and they ask them a series of questions. Are you bullish? Are you bearish? What are the headwinds? What are the tailwinds? Then they tally them all up and they say 80% of the population is bullish. The opinion poll says body in motion tends to stay in motion. As long as they're all still bullish, it's probably going to go higher. There are ways to chart opinion polls. There's statistical indices. Christine, have we talked about options? Are we familiar with options? Do we know what options are?
Some of our students would know what options are.
Okay. So options, if you measure the amount of puts buying versus the amount of calls being bought and create a ratio, it will give you a very clear picture on what's the sentiment about your stock. If there are more puts being bought, sentiment is the shares are going lower. Whether they're right or wrong, doesn't matter. That's what the sentiment is. It's the emotion that goes with the trading. I think that's it for you guys. So in a nutshell, that's technical trading briefly. I have live charts if you guys want examples, or if you have any questions. I've never done this before. I don't know what to expect. So I kept it very quick and simple. If anybody has any questions, I'm happy to answer them now. I will also ask Christine to send an email around with my name and my phone number and my email address. And if you have not just a question about technical analysis, but about anything on Wall Street, pick up the phone. My door is always open, whether it's now, when you're going to college, when you need a job later on, just call. Don't be shy. If you don't ask questions, you won't learn anything. So that we can take care of later. Does anybody have questions about technical analysis now?
Oh, I have one. Can you hear me?
I can, go ahead.
Okay, so when we were going over uptrends, oh, sorry, one sec. When we were going over uptrends, in the slide deck, I was just wondering what's the significance of like the uptrend and downtrend lines if we could just look at the chart. And how do we, so I know you said that like in like the small dips, that's when we can give our recommendation to buy or sell. But how do we know if it's not just going to go lower? Like, how do we know that's when we give the recommendation?
Well, the beauty of this and why we all get paid as much money as we do is you don't know. So you put your time in, you do the analysis, the fundamentals tell you it's cheap. You can never know with certainty for a couple of reasons. There are a lot of things that we can't model for. We can't model for COVID. I'm not sure if you guys were engaged last spring when COVID broke, but I'll give you a quick picture of what that looked like. There we go. So you can't model for things like COVID. Here was about the time COVID was hitting in Asia, this little hiccup right here. I'm going to zoom in and we're going to talk about you having done analysis on this index at this point in time. So Asia was getting hit with this, and what happened? The share price traded down to this moving average, 50 days, traded through this 20-day moving average, but held above, substantially above this 200-day moving average. So the trend, as you can see, if you're following the mouse, was definitely higher. And you look at this and say, this is really cheap here. You tie your fundamental analysis into the technical analysis and say, it bounced off this 50-day support line. I should be buying it. I go to the rest of them. Stochastics, not quite at 20 down here, but close. So definitely says you're inexpensive. These are a little bit tough, right? I have to zoom in for you to get a better picture on, but let's just use the stochastics and the moving average. Those indications would tell you you should be buying it now. And then what happened? A month later, COVID came to the US and this collapse took place. There's no way for you to know that's coming. I shouldn't say that. There's a low probability that you'll know that's coming. So what do you do and how do you use the technical analysis and the trend following to protect the portfolio? The period of time that this graph covers is, let me get this up here. So this is January, December 2020 to April, May, March, April here. If you did buy on this and you have this is a daily chart. If you have a 6-month time horizon, so you're being measured every 6 months, are you doing well or not? Are you outperforming or are you not? And the share price breaks below the 20-day here, the 50-day here, and is still above 80, close to 80 on the stochastics, but it's trending lower. You may say to yourself, it's early enough, I haven't taken a big loss, I'm going to make the sale. When it breaks below this 200-day and is trending lower, you have a question and say, is the trend really broken? If you look at this line, sorry, system's slow because I think it's because I'm on Zoom. So remember we talked about higher highs and lower lows. So I'm going to connect this high, and kind of this high. It's a steep drop, but I'll do it just to give you any, just, there we go. So this high and this high give you the trend. So until the share price gets above that trend line, you don't have confirmation that the share is going to turn around yet. Once you did, it bounced, broke across this what's red and white line that's flashing, and then traded through it a little bit, but generally hit it and bounced, hit it and bounced, hit it and bounced, and then got comfortably above it. So now you've got this low, this high, and this high consecutively lower. This high all of a sudden shows a dramatic shift in the trend. Once it broke through this line, this now becomes support. And let's see if I draw another line here. I'm now going to take this high and this high, piece them together, and I don't know what I just did. There we go. And now that red line is now a cap, and the higher lows become support. Forget about that one, this white one here. So it hit that and bounced. It hit the resistance and traded again. So as soon as you get that cross above this level, then you know you've turned the corner. Your stochastics here below 20 and trending higher. MACD at the bottom and trending higher. PMO trending higher. Copic trending higher. All indicate to you that the share price is going to start to trend higher. Is that a close enough answer?
Yeah, that makes sense. Thank you. One like kind of the same topic, but you were talking about the head and shoulders.
Uh-huh.
Um, so how do you know that you just passed the shoulder and now you're moving on to the head? Because I feel like you'd only know that after, right? Like after.
Well, yeah, and with pattern recognition, it's the same thing. You don't know. What you say is there a reasonable probability this is a head and shoulders pattern? After the first shoulder, you won't know. If you get a shoulder and then the head and roll over, you can then say, there we go. So you can then say, play from current slide. Here, you're not going to know. If you put your hand over the screen and you covered everything from the left shoulder to the right, there's no way to tell, with the exception of you're on that support line where the share price gapped up by the mouse. That becomes a support. So you get the rally up. If it holds that neckline, there's a reasonable probability that you're going to get a bounce there. Once you do get the bounce, you start to form the head. If it is, and again, now everything from where the word head is written to the right, you don't know is happening. But you can say, if it does sell off, if the share price does come in a little bit, it should hold the neckline. And if it doesn't, my thesis might be broken. The trend may be broken. In this picture, it held the neckline. Because you had the left shoulder and it held the neckline on the right-hand side, there's a reasonable probability that next bounce will just be a shoulder. Does it happen always? No. But the patterns that we see in these sequences happen so frequently. Since they started keeping track, hundreds of millions of times these patterns show up over and over and over again for one easy reason. This psychology always takes place. An investor will always feel fear, desperation, panic, and then finally say, I've had enough, I'm selling it. I can't take any more. I can't absorb any more losses. And once everybody says, I'm out, are you guys familiar with the fear and greed index? Okay. So Warren Buffett said, be greedy when everyone's fearful and be fearful when everybody's greedy. So when you're in school and everybody's talking about Bitcoin running to $60,000 and their moms are buying it in between soccer practices, you can be pretty sure that's euphoria, right? You guys are going through this whole process, hopefully to make a career out of this. It takes a lot to learn fundamental analysis. It takes a lot of time and a lot of experience to go through multiple economic cycles, booms and busts. And when people are randomly making tens of thousands of dollars trading GameStop because some guy on Reddit said it was the right thing to do, you can be pretty sure it's euphoria. And when people get euphoric, I get really scared because generally it marks a top. The odd part about that is you don't really know when the top is coming. You also don't know when the bottom is coming. And the inverse of that here in despondency is when that soccer mom goes, I lost everything. I mortgaged the house. I can't do this anymore. I can't put gas in the minivan. I'm never touching Bitcoin again. When people are that fearful, that's when you want to get really greedy because they're just selling and they're not doing the math. They're not doing the fundamental analysis that you guys are learning here. Because when the share price gets to the despondency level, your analysis now blocks out all of that white noise. All of those soccer moms are white noise. Ignore it. Do your math and the fundamentals are going to tell you this is really cheap. Buy as much as you can. So you can use opinion polls, you can use PE levels, you can use technical analysis. They're all going to say the same thing. When it's excessively cheap, it's a good buy. When people are excessively fearful, it's a good buy. When you see extreme levels of oversold here, it stayed below 20 for weeks. People were panicking. When you get to extreme levels like this, I'm going to switch this to weekly. For 5 years, over the course of 5 years, you had an opportunity to buy. I'm going to give it this one at 20. 1, 2, 3 times over 5 years, you had a cheap buy on this index. 3 times in 5 years. People were so distraught, they were just throwing the baby out with the bathwater. So how do you know? You don't. But when the indicators get that extreme, there's a pretty high probability you're right. Make sense?
Yeah, it does. Thank you. That was a really good explanation. Thank you.
Okay. Anybody else?
I have some questions. I have actually multiple questions.
Shoot.
So one question is there's the rise of quantitative and algorithmic trading. How has that affected technical analysis and the kind of study you have?
I'm sorry, say that one again.
With the rise of algorithmic and quantitative trading with firms like, yeah. So how has that affected?
Yeah. So here's a great example. It doesn't, and in a weird way, it can actually help. Remember at the beginning of the presentation, we said you can trade any security provided there's enough liquidity, enough volume to create a definable pattern. So I'm going to switch this. Is everybody familiar with what algorithmic trading is? Yes. Okay. So high frequency trading is here. We're going to do 1 day, 1 minute. So the chart that we had a minute ago was weekly data over 5 years. This is just today on a 1 minute plot. So the bars that we looked at here were, we're going to take this red line that the cursor is over now. This is a 1 minute increment. The hash mark here on the left of that red bar is the opening price for that minute. This is the high for the minute, the low for the minute, and the closing price is the hash mark on the right of the bar, the close for that minute. So look at the patterns. High, higher high, higher high, higher high. You have a trend that's moving up. You don't get confirmation of the higher high until here. This, a little bit of a trend lower. You've got two moving averages that converge and give you a, from this hash mark, it's overbought, it's too high, based on what that 11 minutes of trading before that. So what should happen when I get overbought here, overbought here, overbought here, and overbought here? The share price should trade lower. What did the share price do? Traded lower. Until when? It got oversold. The despondency was in. The algos, they're not emotional, they're machines. But the algos read the investor's emotions very efficiently, way better than I can do, which is why they make so much money. The algorithms are determining what bids and offers are coming in every second. And they're saying, I can see that on the bid side, it's a $10 bid for 1,000 shares. And the best offer is 10 1/4 for 200 shares. So it reads 1,000 to buy, 200 for sale. Which way is it going to go? Probably up. I'm going to bid 10.01 for 100 shares. And when I'm able to buy that, I'm going to offer it at 10.20. He tightens up the spread between the two of them. But that guy that needed to buy 1,000 shares, he just missed out. He didn't buy it. It's now trading a penny higher. What does he do? He pays 2 cents for it, or 3 or 4. And that volume of buyers now moves the stock higher in this trending pattern. And the algos, oddly enough, read that bias of investing on a second-by-second basis. And because they're reading that, and I have the ability to pull this chart that you're looking at together on a minute by minute, if you really wanted to go even more, you could do it by every 30 seconds. So I'm reading what the algos are doing, and the algos are creating a pattern based on the investor's biases. And that pattern works really well if you're day trading. If you're a long-term investor and you have a 5-year time horizon, day trading is white noise. If you're looking for a 100% gain for that, that video game company that we were talking about before, a 27 basis point move over the course of today isn't really going to help. But if you can save 250 basis points over a month-long period and your time horizon 6 months, then it's worthwhile. So it really depends on your investment thesis. Is it 1 day? Is it a week? Is it a month? Is it 6 months? Is it a year? And then you adjust the time periods according to your thesis, whether it's a minute, a day, a week, or a month. And then the patterns just flesh out. Did I lose you?
Oh, I'm here.
All right.
Yeah, so I have another question, and that's what is your framework for setting stop losses, if you set stop losses at all?
The frame of, sorry?
How do you what is your methodology for setting stop losses, if you set stop losses at all?
Okay, so let's go to all right. based on this, your fundamental analysis says it's cheap here. Your technical analysis confirms it. You're at a support level. This looks cheap. This looks cheap. This looks kind of cheap, but it does confirm it in a little while. This looks cheap. I'm going to buy the stock. So I buy the stock. When you're doing your fundamental analysis, let's assume you bought the stock based on PE at that level, and you bought it at a PE of 5, and you say the share, it's going to be expensive when the PE gets to be 10. I know this is a 1-minute chart. Let's make believe it's a 1-year chart. Over the course of this period, you would say stop loss becomes a buy at 5 PE, a sell at 10 PE, whatever the share price is. When I get to 10 PE, that's where I'm going to sell it. In this, you would set up a stop loss based on, again, this is a 50-period moving average. So you're buying it cheap here, you have confirmation, you have to give it a little bit of time to work. Your confirmation on that 50-period average is right here. Well, my stop loss is now going to be that 50-period moving average, regardless of where the PE is. And I will continue to hold that position until it no longer is above the 50-period average here. And I sell. Why do I do it? The 50-period average, during this period in the trend, is a support line. Once it breaks below it, it becomes a resistance line. It will have a difficult time getting back through it. Sold, didn't make it. Got even cheaper. Here, it made it. So if I sold the position here, you guys are blocking my view on price. Hold on. If you look on the right-hand scale, that's the price. So bought here, confirmation here, stop loss put in at 395. Sold here, 397. Repurchased here, 397, no money lost. Sold again when it breaks through here, 397, no money lost. And what happens? It continues. I don't know why I'm not getting more data here, probably the Zoom sluggishness. Let's do this. So I can do it that way. That's one simplistic way to do it. Or we can do, okay, so this is a technical indicator that's based on average true range. What was the high of the day? What was the low of the day? Run some math on it. Run that period over a sequence of time, N, in this case, and then use a standard deviation spread around it. If I've crossed above this threshold here, let's pick something everybody knows. Tesla. Whoops. This is a 6-month period for Tesla. You've run your numbers, it's dirt cheap. The indicators here tell you it's cheap. This one tells you it's cheap. This one tells you it's cheap. And you've broken above that average true range we discussed 5 seconds ago. That average true range now becomes your stop level. Anytime it breaks below that, you're going to, on a closing basis, you're going to make the sale. So you bought it here on this signal. The share price moves up, moves up, moves up. You've got trending confirmation with all of these indicators moving up. And then what happens? It stops moving up. The standard deviation around that average true range also stops moving up. So as the share price is moving, my stop price is moving up with it. When the share price stops moving up, my stop loss also stops moving up until the share price violates the stop loss. I sell the position. For my indicators, the way I would do it, this is a flat position. And I don't know if you can see it because this one's very faint here. These are 2 different indicators. Let me change the color on this so that it's easier to see. There. So once it breaks below this, it's my stop. I'm out of the position. I'm flat. I'm not long it or short it. Once I break below the standard deviation that's a little bit farther away, here, I'm getting short. So I'm short the position here until I break through here again. So there's a dozen different ways you can use technical analysis for a stop. You can use support and resistance levels, moving average levels, oscillators. The one that I put on the screen is simplest because it's share price and the true range based on the share price. There's lots of ways to do it. If you want to have a conversation about it, I'm happy to talk. I can give you 10 different ones. You could set the stops up trailing based on price, based on percentage moves, even based on time.
Yeah, thanks for the explanation.
No worries. Anybody else?
I had a question about technical analysis and stochastic oscillator. I was just wondering if there is like some sort of interdependency between both of them. For example, if you use technical analysis and 80% of them suggest a buy, would this like cause any effect on the stochastic oscillator, like leading to maybe above 80% readings and just like overbought?
So yeah, what you've described is I call them aggregators. So all of these different, here, let's go to this. So each of these sublines here are different indicators. There's thousands of them. Some MIT math guru comes up with something and feels it's good and he publishes it and everybody thinks he's super intelligent. Some of them work really well, but they all work differently. So some are trend analysis, some are counter trend analysis. They only start to work when the trend is no longer intact. Some are oscillators, some are momentum. An aggregator, like you just explained, and Merrill Lynch has a really good one, but I can't access it right now. An aggregator is going to take all of these different types of analyses and give them all a value. Let's just say it's an evenly weighted value. So out of the, I don't know, 30 that you see on the screen, if more than 20 are saying buy or sell, I'm going to put it on a needle and say, when it's 15 evenly balanced, some buy, some sell, the needle's pointing due north. And the closer you get to 30 that are all saying it's a buy, the needle starts to move aggressively to a buy zone. And when the aggregator, sub 15, 10, 5, 0, it's going to give you an indicator that they're all saying sell. Let's go back to the psychology we were talking about. When you have that needle aggregating all 30 of those, and it's screaming buy, everybody's saying buy, the soccer moms are buying again. It probably means people are being too aggressive. And you should start raising red flags and thinking that maybe it's time to readjust the thesis. And when it's at the extreme left, and all of the indicators are telling you it's sold, they're all oversold. And the soccer moms are all saying, oh my God, this guy is falling, I'm never going to invest again. That's the point where you probably want to say, things are looking really cheap, let's get involved. So there are a couple of really good ones. I would suggest there's and I don't know if you guys want to take notes, there's a guy named Michael Hartnett, Hartnett. He works at Bank of America, and he has an index called Fear and Greed. He did not coin that phrase, it was coined back in the 80s, but he's very effectively, and he publishes what those indicators are. They're not technicals, they're sentiment, fundamentals, but it'll give you an idea what those aggregators look like. There's another guy that's technical, Chenkin. I'm probably going to misspell it. Chaiken. I don't remember his first name. He has an aggregator for technicals called the Power Tool or something along those lines. Let me see if I can give you an example of that. Hold on. Yeah. Okay. So these are going to measure two things that'll be time sequenced. Let me fix that. There we go. And there we go. Okay, so let's pick a stock. Let's go back to Tesla. So this is 13 indicators that they've aggregated together. And here are all of the indicators in this column here. The website is Bar Chart, BARCHART. It's free. So they've aggregated these 13 technical indicators, and then they've given them a value that is going to determine should you be buying it or should you be selling it. So is the trend increasing or decreasing? Right now it's decreasing, and the current strength is kind of right in the middle. So I want to find something that's got, let's see, Bitcoin related, Riot. There you go. Perfect. So this is Bitcoin related. It's called Riot as the stock. Current strength, 100. Current direction, 100. Everybody's buying this thing. All of the indicators are pointing up. So let's look at the stock now. And see what it's been doing. Okay. So that thing is the bar chart thing is a short-term gauge. So it's probably measuring this series here. So let's go back and say, all right, you guys are all young. You all know what blockchain is. You all bought it 10 years ago when it was trading at $2. Me, as a baby boomer, I just figured it out here. And this is where I bought it. And I got really lucky. It had this crazy run up. And I went, holy mama Lucia, I can put my kids through college on this stuff. And what happens? The trend is broken. So I bought them here when it gave me the buy signal. I sell it here when it gives me the sell signal. Let's see if we got confirmation. Real cheap here on the stochastics. MACD, real cheap. PMO, not so much. Copic, really cheap. And this one we didn't talk about, so I'll skip that. What happens? The share price moves up. It breaks my stop loss here. Let's see if I got confirmation. This is at the high end. If you want, I can do this. Here, you'll see the hash marks line up. I broke my stop loss on the price at the top chart. And what did the stochastics tell me? It was overbought. It was really expensive. What did it tell me to do? It told me to sell it. So I sold it. And the share price comes in. I'm short. My stop loss triggers, and now I get long. But let's look. So you guys asked, how do you know? You asked about the head and shoulders. You asked about the trend pattern. How do you know? So it gave me a buy signal here on that top chart. But what about the bottom one? What about the stochastics? Is it telling me to buy it yet? Shake your heads or give me a thumbs up or a thumbs down. It's not yet. It's still here. The trend is still lower. It hasn't crossed here. I'm going to sit and I'm going to wait. I'm not going to buy it until this tells me I should buy it. Hold on. Let's see about this one. Same thing. I got confirmation on the sell a day or two later. Here's my buy. Is this telling me to buy? No, the trend hasn't changed yet. It hasn't found the bottom and turned. It doesn't tell me to do that for another 2 weeks. So are they right all the time? Definitely not. But when you put them all together, you're kind of looking at a mosaic, 30 or 40 different small pictures that help you discern what's the bigger picture. It's all grounded in your fundamental research. That's got to be what the picture looks like. Your investment thesis starts with the fundamentals. This helps make the picture visible out of all of the tiny shells. So that bar chart was giving you, let's do 20 days, 7 days, hourly. So this is that period. I'll go 14 days so that we can get the whole thing. So that bar chart swung to 100. Your aggregator that we saw on that last thing started swinging 3 weeks ago. Down here, it would have been at 10, 20. Here would be at 40, 50. Here it turns to 60, 70. Here it turns to 80, 90. And what's happening? You got confirmation to buy, and now it's telling you, hold on a minute. All of the indicators are telling you, buy, 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 buy. And what's this indicator telling me? Be careful. It might not be a buy anymore. The indicator sold off, the share price did not.
Email you about that, but I'm blown away by your technical analysis presentation today. I couldn't be happier. I'm sure everyone feels the same. I mean, this level, we don't really get this technical in YIS. So to be able to have you here and explain it to us, I think we've all learned so much today.
Okay, well, first, thanks for having me. Second, I'm not kidding. Pick up the phone and call. I'm happy to work with you guys.
Tom, if you wanted to put your number in the chat, you can definitely do that.
Grand slam. Okay.
Awesome.
All right,
Thank
guys.
you so much, Tom. It was great seeing you today.
You too. Study hard, guys.
Bye, guys. Have a great week.
Thanks.
See you next week.
Thank you. Goodbye.